In this video, we dissect the precise Greek relationships between calls and puts. The primary distinction between calls and puts lies in their directional exposure, or delta. A long call possesses positive delta, profiting as the underlying rises, bounded mathematically between 0 and 1. Conversely, a long put carries negative delta, profiting as markets fall, ranging from -1 to 0. However, for the non-directional Greeks, magnitude matters more than the option type. 4 at-the-money options at the same strike, gamma, theta, and vega, are virtually identical. Whether you are long a call or long a put, you are long convexity and volatility, while suffering the same rate of time decay. This symmetry exists because of put-call parity, a fundamental concept we touched on in Phase 1. Parity binds the prices of calls and puts relative to the stock and strike price. Because the extrinsic value components are linked, the Greeks derived from that extrinsic value, specifically theta and vega, must align. A vital derivation of this parity is the rule of 1 regarding delta. The delta of a call minus the delta of a put will always equal 1. This explains why an at-the-money call is roughly 0.50 delta, while the corresponding put is minus 0.50. The net difference captures the full exposure of the underlying stock. Understanding these nuances allows you to construct synthetic positions effectively in Phase 5. If you understand that a long call is mathematically just a long put plus stock, you can manage risk more fluidly. We will utilize these interchangeable Greek profiles when we build spreads in the upcoming episodes. Thanks for watching, and see you in the next episode on volatility.